All right, I think we'll get started. I still see some folks joining in, but they hopefully we'll get we've got a quorum. We've got the majority of folks that are here for the presentation today. So I'll just say good morning, good afternoon, good evening to everybody who's joined us from a variety of time zones across the country. So my name is Adam Nellick. I'm a VP of Capital Markets here for Croatan Investments. So once again, thanks for joining our webinar, Uncovering Value in Multifamily Real Estate, Where to Invest Now and for the Future. For those of you that may be unfamiliar with Croatan and who we are, we're a private equity real estate manager focused exclusively on multifamily investments. So for over 17 years, we've been uncovering opportunities with excellent intrinsic value and pricing dislocations within the multifamily space. Today, we want to share with you how we've identified, sourced, and executed on investments in the past, and also share some insight as to where we're finding future opportunities. As you can probably see, I'm joined today by two of the senior leaders from Croatan, Paul Van and Eric Smith. Paul Van's our Chief Executive Officer and Chief Investment Officer, and Eric Smith serves as our Chief Operating Officer. Paul is the CEO and CIO, like I mentioned, for Croatan Investments. Maintaining the vision for Croatan is his main focus, which includes growth planning and corporate culture development. He also guides our overall investment strategy and provides leadership to the firm's transactions function. Paul began his career as an M&A investment banker at UBS in New York City and advised on transactions in the gaming, consumer product, food service, agriculture, healthcare, and technology sectors. Paul then transitioned to Harbor Group International, where he became a vice president of acquisitions covering multifamily markets across the Mid-Atlantic, Southeast, Midwest, and Texas. Paul is currently active with the Urban Land Institute, National Multi-Housing Council, Alternative and Direct Investment Securities Association, and Association of Asian American Investment Managers. Paul received his Bachelor of Arts degree from Duke. Eric, as I mentioned, is our COO of Croatan, executing the corporate growth plan and driving efficiency across the day-to-day operations of the firm is his main focus. He also provides leadership to the firm's capital markets function. Eric most recently served as both COO and CIO for Armada Hoffler Properties, a publicly traded REIT. His experience includes a broad range of asset types, which includes multifamily, retail, office, mixed use, and hospitality. In addition to the acquisition of stabilized assets, Eric has had oversight of over $1 billion of development projects during his tenure at Armada Hoffler. He was part of the 3-member executive team that shepherded Armada Hoffler through its 2013 IPO on the New York Stock Exchange. Eric has his Master's of Business Administration from the Wharton School at the University of Pennsylvania and a Bachelor of Science in Finance from the University of Connecticut. Before we dive into the presentation, I must inform the audience that the investment vehicles which Croatan manages are suitable for accredited investors and sophisticated investors and institutions. Therefore, if you're not an accredited investor or you don't believe that you meet the threshold, we kindly ask that you disconnect from the presentation now. Today, our main presenters, as I highlighted, will be both Paul and Eric. Paul is going to give us a brief introduction into the history of Croatan, an update on the multifamily industry, and then an in-depth overview of Croatan's current investment strategy. We'll then hear from Eric for an overview of our investment vehicle, the All-Weather Fund, which is the vehicle that serves as the execution agent for our investments. So thanks again, everybody, for joining. And with that, I'll turn it over to Paul Van.
Thanks, Adam. And thanks, everybody, for being here with us today. Now, to start, let's tell you about Croatan's belief system. You'll see on the front page of all of our marketing materials and on the landing page of our website, the words, a passion for uncovering new opportunities. Now, what does that mean? As an investment firm, investment opportunities are clearly a big part of that, but there's more to it. We believe in the opportunities to continue to push and challenge yourself to improve. We believe in the opportunity to continue to build a high-performing team. And lastly, we always try to find opportunities to help others in the community. Now, a byproduct of this belief system is our culture is very, very innovative, and we have a high growth mentality amongst the team. Now, about Croatan Investments, what we do, we are an investment manager focused on multifamily rental housing. As you can see from this page, we've transacted on over $1 billion in transactions with a high level of success as demonstrated by our gross IRR of over 30% and our gross equity multiple of almost 2.4x. We're also currently in the market with our All-Weather Fund, which will have some unique economic benefits that we'll get into later, and also serves as a quasi-GP fund of certain executions. Next page. Now, let's go through some of the advantages that have led to our success over the past 17 years. a couple traits. First, we are very experienced in the multifamily investment management business. Our infrastructure is fully built out, developed, and led by experienced leadership and strong leadership. And we've had a proven track record. Over the past 17 years, we've done this over multiple points in time in the market cycle, including a couple of downturns and growth cycles. And each time there was a downturn, we've emerged stronger than going in. And last, we have actually by design have built out our company to be durable and resilient to shocks. And we've done that by having diversity, not only how we raise our capital, but also how we invest our capital. Next. And this is a snapshot of the executives of this company. Adam did a great job of highlighting my background and Eric's background. There's a third executive on this team. His name is Jeff Mack. He is our chief administrative officer, heads up portfolio management. Now, before he joined us, he was one of the key leaders that helped build out the East Coast platform for a very large real estate private equity firm, CIM Group. So the common thread between us three is not only do we each have decades of relevant real estate industry experience, we also have experience building platforms, leading teams, and managing bigger initiatives. Next. So let's give you an overview of our corporate infrastructure. We have four main divisions. The first one is capital markets. This team raises capital for us. As you can see, we raise capital from distinct sources, ranging from private wealth to doing joint ventures of institutional private equity funds, and also raising capital for retail investors utilizing the independent broker-dealer as our distribution. Next, we have the transactions team. They source the investment opportunities for us. And as you can see here, we also invest in different ways, ranging from acquisitions to development to structured finance investments. Next, we have the portfolio management team. This team's the execution team. They're tasked with implementing the business plans on all of our investments, whether it be asset level or fund level. Last, we have the corporate operations, the foundation, the backbone of the company. And without corporate operations, there would be no company to run. Next. And this page demonstrates that no firm or individual achieves success on its own. As you can see, we've done several joint venture investments with institutional caliber partners, and we work with a national and regional support team of legal, accountants, and property management. Next. So let's talk about multifamily for a second. Now, multifamily as an asset class can come in all shapes and sizes, and we listed here just some of the key characteristics and traits. First, you can have different types of geography, whether it be urban core locations such as downtowns, lower density suburban areas, larger gateway cities, or even smaller secondary, tertiary cities. You can also invest in across different regions. Next, you have different physical configurations. Garden properties are lower density apartments that tend to be 2, 3, or 4 story. Next, you have higher density mid-rise and high-rise projects would tend to be higher density and generally have some type of element of structured parking or high density parking attached to it. Last, you have build to rent, which is a emerging subset of multifamily. And what that is a community of townhouses, duplexes, or single family residences that are operated together as one rental community and essentially serves or functions as a lower density apartment housing complex. And actually different asset qualities. For those that have been in real estate, you might have heard the term Class A, B, and C. Now, what does that mean? At Croatan, we look at it in 2 different ways. The first one is from a physical condition perspective. And starting with Class A, the characteristics of that would generally be higher credit profile of the renter base, higher price points as far as the rental side relative to the submarket. And these properties tend to have all the cutting edge and leading amenity packages and all the bells and whistles. And while not always the case, they also tend to be newer. And on the other side of the spectrum, you have Class C, which would tend to be older, caters to a lower credit and lower income tenant base, and may have some age and wear and tear to it. And you have Class B, which is somewhere in the middle. As far as location qualities, Class A locations for us would, you guys have probably heard the term located at Main and Main. So what does that mean? Generally speaking, these locations would have access to key nodes or hubs within the city, nearby proximity to vibrant retail and commercial uses, higher income demographics, higher growth and higher commercial activity in the nearby area. Whereas Class C properties tend to be located in working class to middle class locations that may have a little bit more age and may be a little bit off the beaten path. Then you have Class B, which is somewhere in the middle. You can also invest, or you can also have multifamily that may sit at a different point in the life cycle, starting with ground up development, which is a brand new property. then once it's developed, an asset goes to a lease-up phase where it's built, but it's not fully stabilized on the occupancy or economic occupancy side of things. Next, you have a fully stabilized property. The last, you may have a property that has some age on it and the potential to renovate and reposition it, and that would be a value add execution. Asset level strategy follows closely along that, and you have core plus, and those are generally considered safer investments where most of your return is expected to come from cash flow. On the other side, you have value add and opportunistic. Those tend to be a little bit riskier, where you're investing in those with a projected return to come from capital appreciation and back end growth with some cash flow, but mainly you're investing for the back end growth there. Last, you have different operational characteristics. Market rate apartments are apartments that can lease to anybody of all shapes and sizes and ages. You also have properties that may have affordability or income restrictions. Last, you have certain properties that may have age restrictions. And of that, the most popular would be 55 and older or 62 and older age ranges to qualify to live at these assets. Next. Now, how can you invest in multifamily? This page shows you the concept of a capital stack. And essentially what that is the different owners in a piece of real estate. This could be multifamily or any type of real estate, but let's focus on multifamily because that's what we do. Let's start first with the senior debt portion of the capital stack. Now, what really classifies it in the simplistic fashion is prior of payment or repayment from cash flows from the property. So as a senior debt holder, you are first in line to get paid. That puts you in the safer position in the capital stack, and your return potential should be expected to be lower than the other participants in the capital stack. And those tend to be, as far as capital source side, you have different options such as Freddie and Fannie, you have the agency lenders, you have CMBS lenders, banks, life cos, and even private debt funds. Now going to the other side of the spectrum, you have equity. Now the equity owner tends to be the controlling owner in the entity. They also are in the first loss position. So they're also last, which means they're last to get repaid. On the flip side, that also means they enjoy most of the upside from the investment if there is outsized growth potential or growth achieved on that asset. Then you can invest somewhere in the middle portion of the capital stack, and that often comes in the form of preferred equity, mezzanine debt, or junior debt. And the investors or participants in the middle of the capital stack, if that exists in the deal, enjoys the benefits of both the senior debt and equity, in that they're second in line to get paid. They have some of the safety of the senior debt holder, but potentially some of the higher returns and some of the upside as the equity, but generally speaking, not as much. Now, as far as the investor base or capital sources for the top portion of the cap stack or the middle portion of the cap stack, those could be very diverse, ranging from retail investors, private wealth investors to institutional investors. Next page. Now let's talk about the basics of why multifamily has been so great, not only for Croatan, but for those that have invested in that asset class. If you think about multifamily, what are we investing in? We're investing in housing. And housing is a non-discretionary need that everyone needs, right? Shelter. Everybody needs a place to live. Now, how people live or where they live may change over time, but the commonality is they still need a place to live. So as a result of that, time and time again, multifamily has demonstrated itself to be able to deliver very, very strong risk-adjusted returns compared to other alternatives over the past couple of decades. Also driving that has been just the general expansion of the renter base, whereas 10, 15, 20, 30 years ago, the American dream was to own a home. Actually, rentership is now an equally accepted form of living, and for a certain cohort, and actually a preferred form of living over owning a home that may have associated with it maintenance and just the inability to be as flexible as far as your logistical situation. And last is actually probably the most powerful tailwind for multifamily is we just have a fundamental supply-demand imbalance. There is not enough housing in this country. And that actually applies to not only rentership, but also home ownership. NMHC and National Apartment Association did a study a couple of years ago. And in that study, they estimated that we need 4.6 million apartments for the next 13 years just to meet demand. And when you do the math, that actually represents a record amount of volume for 13 consecutive years, just as far as new deliveries go. And that's a pretty big number. Freddie Mac did a study recently, and they estimate that the country currently needs 3.8 million single-family homes to meet demand. And those are, once again, really, really big numbers, and we don't really see any likelihood or any really major catalyst for that supply demand imbalance to go back to where it needs to be. Next page. And this page highlights what we mentioned earlier. It compares the returns over the past 30 some odd years of private multifamily, which is what we focus on at Croatan, compared to general real estate, public and private, of all asset classes, and then also equities and bonds. And the takeaway here is private multifamily has demonstrated itself to deliver the returns of general real estate and equities, but also have the stability of bonds. It really is the best of both worlds. Next. Now let's talk about how multifamily did during the COVID pandemic. And I think it's proven itself again, once again, to be one of the more durable asset classes out there. And this year compares values of all the major food groups in real estate, and those would be industrial, multifamily, office, retail, and hospitality. As you can see, industrial and multifamily were the shining stars, with both of those asset classes showing positive year-over-year value growth. On the other end of the spectrum, retail and hospitality, those were the two hardest hit sectors during the pandemic, as the world shut down and people didn't go out shopping or didn't travel. And then also online shopping became a big headwind for brick and mortar retail. Now, as you can see, there was negative asset values. Hospitality is tough to track because not much cleared during that time frame, but just we suspect that it would be by far the most dramatically hit asset class. And then when you look at occupancy, effective rents, and absorption for multifamily in 2020 over 2019, as you can see, there was a slight dip, but overall held steady. Absorption notably came in at 296,000 units in 2020, which was a slight drop in 2019, but it was in line where it was the prior 5 years. Next page. Now within multifamily though, the performance wasn't even though the asset class as a whole did really well. The takeaway from this page was the shining star within multifamily was Class B housing in Sunbelt cities, lower density Sunbelt cities. And on the other end of the spectrum, the toughest hit, or the toughest performer, worst performer would have been higher end Class A housing in high density areas, in particular large gateway cities. And why was that? Well, you think about it, during the pandemic, the world shut down. So people were able to work from home. They weren't tied to being close to the office. And in the downtown areas where generally you would live there, to be close to the entertainment centers, restaurants, and the nice amenities, those were shut down. So a lot of the benefit of living in a high density area went away. And then that was compounded by the fact that due to safety issues, people just wanted to be able to spread out and go to a lower density area. And another dynamic was during a financial crisis, I think a lot of renters downsized from higher end or more expensive Class A housing down to Class B. Class C, it's a little uncertain. When you read the reports, the occupancy numbers actually would tell you that it held up pretty well. But we actually think that there might be more to it than what the public reports may indicate. When you think about the COVID pandemic and the job loss, the Class C renters were hit the hardest. Most of the job losses were in service sector, retail, hospitality, and those tend to be the heavy renters in the Class C segment. So we actually believe that there's a lot of back rent and delinquencies that may not be fully reflected in these public reports. All right, next page. So how's multifamily doing year to date? To cut to the chase, it's still doing really well. It continues to stabilize and show positive rent growth. Notable is this term that you see us that we highlight in the third bullet called Zoom boom towns. Boise's a big example of that. Those cities have really seen outsized positive rent growth as those workers that were living in, let's say, San Francisco, now we're able to migrate and live in a place like Boise. We are now seeing actually gateway cities, the cities that were the hardest hit during COVID, they're now starting to show signs of life and the signs of a bounce off the bottom in recovery. We're seeing positive rent growth in areas like San Francisco, DC, Boston, even New York. We don't mention it here, but we're seeing signs in New York starting to turn positive now. Downtown rents, not just in the gateway cities, are showing positive rent growth. So it's interesting. We're going to really see what happens with the dynamic between gateway city recovery and the boom towns like Boise on where that may head over the near term. I say for us, we're definitely getting more and more bullish on the gateway city recovery story. As far as new supply and construction, 2021 is expected to have a big number of 400,000 units delivered. But we actually believe that a lot of that was just spillover from the prior year, because as the world shut down, projects got slowed down, and we think there was just a lot of that, a lot of delays that are spilling over. So that is not really alarming to us to see that number. And then to really add to that point is over the past year, year and a half, construction costs have just spiked dramatically. Raw material pricing is spiked, notable as lumber, which has grown 400, 500% over the past year or so. Even other materials like OSB plywood, supply chain issues, you can't get appliances anymore, labor's in short supply. It's tough, and that's really put a lot of challenges as far as costs and delivery schedules on renovations and development. Next page. Now, to echo on that same theme, this chart just shows you historical and projected supply demand. And for the most part, supply demand has been very favorable for apartments as far as the demand drivers and not enough supply. We took a dip in 2020 and 2021, is expected to be a little imbalanced with a little bit excess supply. But I think that's really largely driven by just the economic softness and pandemic. Even though the multifamily industry held up well, it wasn't a gangbuster year by any means. Now, notable is starting in 2022 and beyond, the forecasts call for demand to dramatically outstrip supply. So I think that we're going to really have a nice run going forward for the next couple of years in multifamily, just due to the fact that the supply continues to be a challenge for I guess for renters, but great for investors and landlords. Next page. So let's talk about now how we invest. So at Croatan, we have a 3-pillar investment thesis, and I'll hit it high level on this first page, and then we'll go into detail over the next couple of slides. But pillar 1 is laser focus on multifamily. Pillar 2 is invest where people want to work and live. And pillar 3 is seek inefficiencies across the market cycle. Now, by utilizing this 3-pillar thesis, we have been able to combine what we feel to be the best of both worlds, where you have a very stable, low volatility, steady, great returning asset class like multifamily, invest in great areas. But then with our pillar 3, which we'll get into later, we're able to layer in excess outperformance, the alpha, and take advantage of short-term cyclical opportunities. So let's go into the 3 pillars. Pillar 1, laser focus on multifamily. This is what we do. We live, breathe, and sleep it. We know what we're great at. We stick to our knitting, and it's in our DNA. These are the 3 main points that we actually went into detail in the prior slides of why it's a great asset class, recession resilient, has generated long-term stable returns. The renter base is growing, and there's just a fundamental lack of supply. Next page. Now let's talk about we invest where people want to work and live. And what does that mean? We're investing in housing. So we follow rooftops. We want to go to areas and markets that are exhibiting favorable population and job growth. And for the most part of my career and for the near-term future, that is the Sun Belt. And as you can see by the color charts, there are certain parts of the country that have outperformed and led the recovery and continue to lead. And until that data changes, who knows, right? We're not married to the Sun Belt, but if the data tells us that there's a shift somewhere else in another part of the country, another region, we will surely adapt and adjust accordingly. Next page. Now let's talk about pillar 3, seeking efficiencies across the market cycle. So from our perspective, if you know your asset class so well, and in our case, that's multifamily, and if you have your geography and your markets dialed in, and in this case, it currently is the Sun Belt, we actually think you're shortchanging yourself if you just stick to one type of execution. And types of executions can range from buying workforce housing value add properties to buying shiny trophy high-rise core properties to even doing a ground up development. And it's not that any single one of those are by themselves a bad or poor execution. They're actually all great executions. But the market may change as it has and it will continue to do so. And there may be some points in time in the market cycle where that one execution may not be optimal. And that's all you do. You may be forced to compromise your standards to do subpar deals. So we actually prefer to take a very agnostic approach to how we invest, so long as multifamily in our geographies. We're agnostic. We are ready, willing, and able to pivot between different geographic areas, the urban core, suburbs, big markets, small markets, up and down the asset quality, class A, B, and C, different configurations, high density, low density apartments, even life cycle. Sometimes development makes more sense. Sometimes buying existing product makes sense. And we even have the ability to go up and down the cap stack. there are certain points in time where perhaps investing as preferred equity mezzanine debt offers a compelling return over investing as the equity. So with that creativity and flexibility, what we do is we try to find dislocations, pricing glitches, inefficiencies, and once we've identified those, we build up our position. And then when the market catches up, it's not a matter of if, it's when. When the market catches up and that inefficiency goes away, it becomes overly efficient, we monetize it, but then we go on to the next inefficiency that we find. And that's how we invest. So let's go to the next page and see our body of work and how we've done that over the past 17 years. There's a lot of information on this page, so I would say just everyone pause and look at it. It's a timeline, and I'll walk you through step by step how we've navigated the cycle over the past 17 years. We were founded in 2004. At this point in time, we were coming at a downturn, at the tail end of a downturn, and that downturn was driven largely by the dot-com crash. 9/11 had a huge devastating effect on the market and the economy. And renters at this point in time, they were able to obtain mortgages, and this was leading up to the housing market peak. So a lot of renters became homeowners. So we actually saw an opportunity to buy great properties in the Sun Belt, low risk, core plus current income plays, and buy at rock bottom fundamentals and ride the wave up. And that's what we did that for a couple of years. Then we got to the mid 2000s and we thought the market became dangerously overvalued. We sat out the market for 2-3 years. And the dynamics at the time were the trading multiple for real estate cap rates. They were sitting at 5%. The cost of financing was sitting at 5%. And the yield you would get by buying a very safe 10-year US Treasury was 5%. That to us was bad math. We just knew it wasn't going to end well, sat out the market, and then when the global financial crisis hit and the world was falling apart, we were playing from a position of strength and were able to deploy capital. We started buying properties from REITs, publicly traded REITs, who had to sell assets to raise cash to fix their balance sheet. And we were buying at cap rates that we had never seen in our careers. And then a couple of years later, we actually saw an opportunity to take advantage of a fractured capital markets environment where we saw the ability to finance properties as preferred equity mezzanine debt and make better than equity returns. Did that for a couple of years. The market recovered, the capital markets settled down, became overly efficient. So we actually saw another opportunity in 2014. So when we looked at the real estate in our neighborhoods, which were suburban properties and really nice Sunbelt cities, we actually realized that the older housing stock, the Class B and C housing, the rental rates on those assets had trailed the high-end housing stock, the Class A rents, by the widest margin that we had ever seen in our careers. So we actually became a very active purchaser and renovator of Class B and C housing, transforming those assets to Class B plus A minus level, pushing rents 20, 30, 40%, and creating a lot of value through that execution. Value add became very, very popular and became overly efficient a couple of years later. So we pivoted again. We saw another inefficiency. This was more of a geographical cap rate dislocation where properties in our hometown here at Norfolk, Virginia Beach, they've historically traded at a discount to comparable quality real estate in other cities. But it wasn't until we realized that discount had widened out, gapped out to the widest that we'd ever seen in our careers. Did some research, realized that it was over adjusted and too cheap. So we actually became the most active investors of apartments, high quality apartments in this area. And now that that pricing gap has fixed itself and narrowed, we actually may become the most active seller of properties in this area in the next couple of years. In 2018, 2019, we actually felt that the market was reaching a peak as far as liquidity goes, and not a dangerous peak like what we saw in 06 to 08. Nonetheless, there was a lot of liquidity in the market. So we actually became more defensive, started selling some assets, refinancing real estate that we wanted to own throughout a downturn, not knowing what that downturn would look like, to mitigate our capital markets risk and refinancing risk. And then we actually decided to launch a new execution with, within our firm to actually securitize real estate. And the concept there is when liquidity is high, there's a lot of demand for real estate with high quality investment managers. So it's very profitable for an investment manager to bring out product offerings for that investor base. Excuse me. So we launched a securitized offering, a niche product targeting 1031 investors, got our first one done, then COVID hit. And then we took a step back, analyzed the market, and actually have found more unique and interesting ways to deploy our capital. And that brings us to where we are today of our investment themes on the next page. So how are we viewing the market today? Well, if you go back and think about how the fundamentals were in multifamily, and like we said earlier, the fundamentals have been the strongest in Class B suburban garden properties in the Sun Belt. Well, not surprisingly, capital is also the most liquid in that subset. And that also means prices have been bid up. And so not that they're bad returns or bad deals, but when you look at a normal acquisition of suburban garden property in Sunbelt, based on our numbers, we're forecasting gross IRRs 8 to 14%. Once again, that's not a bad return. It's actually pretty attractive in this low return world. But we actually view the world differently because once again, we'd like to take a more nimble, flexible approach to the market, and dynamic approach to the market. So when we look at that dynamic of these suburban assets trading at premium values relative to historical values, we'd actually rather be a producer of that product. So developing that asset at wholesale prices, then monetizing it at a premium to retail, that to us is a more compelling opportunity. So we're focused on suburban development, whether it's low density apartments or whether it's built to rent, lower density townhouse communities or single family rental communities operated as apartment complexes. Next, there's still a lot of liquidity out there in the market. So we actually are looking to put a lot of efforts and scale our DST, which is the 1031 product, the 1031 securitization product. And we can take a safe, stable apartment complex, securitize it, and make an opportunistic return because there's lots of demand for that product type. We'd rather do that. Next, this one's somewhat going against the grain as far as capital markets flow, but going with the grain as far as how we view the market and our conviction behind the recovery of the downtowns and urban cores. So whereas all the capital is focused on suburban garden assets and low density housing, it's not focused right now on high density housing. So we actually see an opportunity to buy mid-rise, high-rise apartments for 75, 80 cents on the dollar relative to the cost to replace it with very minimal competition. So that's very, very compelling to us, especially given our conviction and belief in the recovery of the downtowns and urban cores. Last is, if you can buy an apartment complex and make an 18 to 14% return, that's fine. But what if we could finance the same project as preferred equity mezzanine debt and make an 11 to 14% return? That is interesting to us. So even though the nominal return may be very similar, the risk-adjusted return is phenomenal when you consider the fact that the pref equity mezz debt junior debt holder is second in line to get paid after the senior debt holder. So this is just a snapshot. Now, I can't guarantee how we invest in 2-3 years may look or feel, but what I can guarantee is we will still continue to adopt the same philosophy, that same 3-pillar investment thesis, to try to find those interesting, compelling relative value plays or dislocations in the market. So next page. So that's the high-level Croatan story. And with that, I'll pass it off to Eric Smith, who will go into details of our all-weather fund, which, like we mentioned earlier, offers some unique economic benefits to our investors, and also in certain cases, functions like a quasi-GP fund. Thank you.
Thank you, Paul. Appreciate it. As Paul mentioned, I'm not going to spend an enormous amount of time here, maybe 3 or 4 minutes. I think the interesting part of understanding how we execute our opportunistic investment thesis through the all-weather fund would be helpful after Paul touched on our business model and our current investment themes. So this first page we're looking at is a pictorial representation and really highlights that the all-weather fund is the vehicle through which Croatan Investments is executing the opportunistic investment thesis that you've now heard Paul articulate. It's the wealth building vehicle for the principals and employees of Croatan, as well as the folks who've been investing with us for 2 decades now, and new investors that are joining the Croatan team. The all-weather fund provides us that GP-like vehicle, and we can invest in a couple ways. And the first one being the smaller dark gray circles, and these are kind of one-off opportunities. Sometimes you identify an inefficiency or dislocation, and you can get a couple executions done before kind of the window closes. And these, not unlike other GP-like investment vehicles, would be funded from the GP capital from the all-weather fund, with most times institutional LP capital rounding out the equity for the investment. In other cases, we're able to seize on an opportunistic investment thesis and an opportunity with some scale and scope, and that's what these larger light gray circles represent. when there's an opportunity to execute on multiple opportunities within a thesis. The all-weather fund can still serve in that GP capacity with a larger bucket of LP capital to be able to execute with scope and scale. But the important part being that the all-weather fund is the tool that gives ourselves and our clients access to this complete opportunistic investment thesis. So next slide, please. There's a lot of words on this page. There's three things I'm going to highlight, but this page really speaks to, okay, you've heard all about the opportunistic investment thesis of Croatan, the opportunities we're currently seeing in the market. How do we functionally execute? How do we tactically execute on the opportunities? And there's two large ways we do that. The one buy and hold and the second buy and syndicate. So let's talk about those as the first main takeaway from this page. On the buy and hold side, this is your typical acquire an asset, make an investment. You have some period of time you plan to hold it, execute a business model, and then ultimately exit that investment once you are able to monetize the value creation from executing your business plan. And there's two ways we execute on buy and hold. The less frequent way is a partnership buy and hold. The partnership being the all-weather fund partnership. That's when we fund an investment exclusively with all-weather fund capital. That is atypical of a GP fund, obviously, and thus we save that for very rare circumstances. Typically, when we execute on the buy and hold side, we're doing so under our co-investor buy and hold strategy. That's where we're utilizing, these 90-10, 95-5 structures where the all-weather fund is providing 5 or 10% of the capital for investment, and we're leveraging one of those LP institutional capital partners you saw listed in the front part of the deck to fund the rest of it. And that's like I said, that's the predominant execution of buy and hold. On the buy and syndicate side, again, I would encourage you to think of our buy and syndicate execution is just another opportunistic way that we take advantage of an opportunity. This happens to be a liquidity opportunity in the marketplace. When liquidity is high and there's a lot of dollars, including dollars on the retail side of the capital markets looking for investment opportunities, there's a real opportunity for Croatan to bring institutional caliber private equity capabilities and provide the retail investors access to well-vetted, well-sourced investment opportunities. And that's what we do. We buy the asset using all-weather fund equity. We then do so with the intent to immediately securitize and syndicate it out. And then we're able to provide the retail investors access to compelling investment opportunities while allowing our all-weather fund investors to make a nice return by providing the capital for that initial acquisition. The bottom of the page is kind of the other point I want you to take away from this page, and it demonstrates a nice alignment of incentives with our investors. You'll see for the partnership buy and hold and the buy and syndicate that our fee structure is a typical 2 and 20, 2% annual AUM fee or assets under management fee, and 20% promote or carried interest. However, on the co-investor buy and hold, which as I mentioned is a preponderance of our execution, our fee structure is actually 2 and 0. And so we're able to provide some very compelling economics for our clients and investors. You'll see later on in the appendix when we get there, I'll briefly mention it at that point as well. But when you take the all-weather fund fee structure, this fee structure you see at the bottom of the page, and you apply it on a pro forma basis retroactively to the $1 billion of investments we've done, you actually come out with a blended 2 and 8 structure, which we think is a very compelling value proposition for our investors to get access to an opportunistic investment strategy that's able to pivot to the highest and best use of capital in the multifamily space at any given time with some really attractive economics. So Katie, next page, please. This page really serves to demonstrate one of the powerful tools of a GP style fund. This is predicated on the left-hand side, as you can see, on a $100 million all-weather fund. And we've just, for purposes of demonstration, allocated 50% of this fund to the top portion of the page, which is co-investor buy and hold, where we're leveraging that institutional LP capital. And the bottom 50% of the fund is being allocated to the buy and syndicate strategy. So let's look at how much transactional volume we can actually execute with a relatively small amount of capital. So on the top side of the page, if you take 50 million of all weather fund capital, combine it under 90-10 with LP institutional capital, i.e. 450 million of LP capital against the 50 million from the fund. We're working with $500 million or so of equity in this example. And at a typical 2/3 leverage ratio, that's $1.5 billion of assets of opportunities you can go execute on. On the bottom half of the page, if you take the other $50 million, and again, at a typical 2/3 leverage, that gives you $150 million of asset purchasing power. We typically think we can turn our syndication business 2 to 3 times a year. Each syndication should take somewhere between 2 to 4 months. Our last syndication we did of approximately a $9 million syndication to the retail space. When we went live, it took 2 weeks to get it fully subscribed and sell out. So that's a reasonable estimate in our view. If you in fact turn 150 million 2 to 3 times a year, you can approach another $500 million in transaction volume. So you can quickly see how one of the benefits of GP Fund is the amount of diversification we can provide our investors, not only through the opportunistic investment thesis and pivoting to the highest and best use of capital, those highest risk-adjusted returns, and simultaneously diversify across the number of opportunities that we can pursue, given the way we leverage institutional LP capital and the number of turns on our balance sheet and the buying syndicated strategy. I think another compelling value for our clients and investors. Next page, please. This shows you the 7 investments that are currently in the all-weather fund. I'll go through them quickly because I think they're nicely emblematic of the opportunistic investment thesis and some of the current themes that Paul spoke about. The top 3, Trail Creek, Park Crescent, Sparrows Point, are all co-investor buy and hold strategies that were done with an institutional JV partner. We purchased those prior to the launch of the fund as seed assets for the fund. We then sold them into the fund at cost for the benefit of the fund investors. The 2 on the right-hand side, Villas at Cordova and Sutter Ranch, are preferred equity investments. Again, earning mid-teens returns on high-quality assets and only taking risk up to the 85th dollar of the capital stack. So really compelling risk-adjusted returns on mid-teens nominal returns. Attic Stone Village is the buy and syndicate offering. It happened to be syndicated in the DST space, the DST channel, which some of you might be familiar with. And again, that was the one I mentioned, syndicated fully over a 2 week, or fully subscribed over a 2-week period. That was the first buy and syndicate execution that we did actually inside the fund vehicle. And then Skyline Atlanta was a partnership buy and hold. And when I think a good representation of that urban core rebound investment thesis that Paul discussed earlier. Next slide, please. These are a summary of some of the fund economics and features. I'm not going to go into this in detail at all. If you'd like to reference this at your own leisure, we would welcome that, encourage that if you're interested. The one thing on this page I would highlight, because I think, again, it speaks not necessarily to the fund itself, but to Croatan's philosophy, and that's the term, the fourth one down. The term, as you can see, we show is flexible. And we mentioned that the capital and profits are reinvested until redemption. We just don't fundamentally agree with having a fund that has a defined exit period of 7, 8, 9 years, et cetera. We don't have a crystal ball. Nobody has a crystal ball in what the macroeconomic backdrop, the macro liquidity backdrop, or any other backdrop is going to be, 7, 8, 9 years from now. We do know that there will be future dislocations and inefficiencies and thus investment opportunities. We don't know exactly how those will manifest themselves, but we're ready to pivot and identify them as they develop. But having a predefined time to sell a portfolio of investments does not fit, we believe, the best interest of our investors, and certainly doesn't fit our opportunistic investment strategy. So rather, we will continue to keep reinvesting the capital invested in our fund and the profits. And that's consistent with it being a wealth accumulation tool that we mentioned before. Of course, we have that married with all the typical liquidity optionality that investors need. So after the investment period, an investor can simply opt out either partially or entirely at their own discretion. And there are all the liquidity features to liquidate a position and return all your original capital plus all your profits. But we think that's the best of both worlds, which is take advantage of opportunities, keep reinvesting, build that wealth, and provide investors with liquidity optionality at their sole discretion as investors would demand. So with that, we'll now get to the appendix. I'll just reference what's there. You can see a summary of our team, our broader team of 21 professionals that it takes to do what we do. We're very proud of the team we put together, and there's a lot of talent embedded on this page. The next item in the appendix is some detailed information about our track record. And here you can see all the investments we've made across the last 17 years. This is where you can see the detail behind the gross IRR we've generated of north of 32%. And when the all-weather fund fees and promote structure are layered on retroactively, we get north of a 25% net IRR had these all been under the all-weather fund vehicle. And so we enjoyed that at your leisure as well. And with that, I think we're going to open it up to Q&A. Please feel free to ask us any questions that you have either about the firm, about all of the general multifamily information that Paul went through, including our current investment themes, or certainly any questions you have about the fund. And if you don't get your question answered today and we run out of time, please feel free to contact any of the 5 people listed here and on the call with us today, as we're more than happy to field questions a day from now, a week from now, a month, a year from now. So feel free to reach out if you're so inclined. So with that, I think we're going to open it up to Q&A.
A quick note before we dive in, because I see some are coming in. Everyone should see both a Q&A and a chat button, hopefully at the bottom of the Zoom. You can either send chat message to all the panelists where we will see it, or Q&A, which we'll go through. And for anyone that was looking for the presentation note, you can go into the registration page that you or email subscription you got, go into that, and actually this presentation will be there for anyone that wants to download. So if there's things that you want to dive into at a later date, like Eric said, you can get this presentation and then reach out to any of the 5 of us on there, and we can have a more granular conversation. But I think with that, we should jump into maybe some of the questions. And for the benefit of the folks that are on the phone and can't see anything, I'll just read these questions aloud, and then Eric and Paul let you all kind of answer these. The first one was, it sounds like you got a lot right through the cycle. Is there anywhere you went wrong, or potentially lessons learned? That's the first question.
Yeah, I'll take that one. I will say we've had a strong track record, but it wasn't always easy. And one example, I'll highlight one particular asset, and there's a lesson learned there. And this is actually great property in Raleigh, Cary, which is a high-end suburb of Raleigh, located at Main and Main within Cary. Walking distance to Whole Foods. There's a Harris Teeter across the street from you. Class A minus asset. Now, we bought this one. When was that? I think 04 or 05. And it was 180 units, of which about a third of those were operated as furnished corporate rentals. And with nightly rentals. So it was essentially a third hotel and 2/3 apartments. And our thesis at the time was that hotels are very cyclical. And since we believed in economic recovery, we could have got double the benefit. Hey, this is great. Apartment recovery and then hospitality market recovery. And we operated ourselves, self-managed that one. It was a nightmare operating a hotel. 60-unit hotel embedded in a 180 apartment complex. What made it even more challenging was during the downturn, the financial crisis, what sector got hit the hardest? Of course, hospitality. So the occupancy of this asset went from 90% to 95, 90% on average, because hotels tend to be higher vacancy on average. So the overall 90% dropped down to 80%. Fortunately, we still covered the mortgage, and we also had a long-term fixed rate loan on it, so we didn't have any issues there. But operation was a challenge. We were stressed for cash flow. So what we did was we actually decided the right move was to defurnish those 60 units, convert it all the way back to conventional apartment complex and get the occupancy back up. And that was a heavy lift. You don't just do that overnight. So it was a very challenging execution for us, but we got it done, and we were able to monetize and sell a couple of years later at a profit. It wasn't one of the 32%, but I don't remember where it was, but I think we did pretty, I think we did okay on it. It might've been a single a single for us, but it was a harder single. So lesson learned was stick to your knitting, which is why it goes back to being laser focused on multifamily. And even that one, even though it was on the surface a multifamily project, there's still some nuances in it that we probably should have been more aware of and careful about before going in.
And we got to dovetail this, Paul. In situations like that, what has Croatan done in the past to communicate with LPs?
Oh, we communicate. I guess if you get our investor letters, you'll know that we actually like to talk a lot. They're very long letters, and we're full transparency. And we tell them, hey, we're trying our hardest, and why it's not covering cash flow. The occupancy at the hotel units, I'm gonna call it the corporate housing units, were very low, but we are working on a plan to get it turned back around. And all you can do is just tell them the good, the bad, and ugly, and what we're doing to fix those issues.
Thanks. Going through the Q&A, and we'll try. There's, I think, two that are quick that we can get out that are just about structure. Do we accept self-directed IRA? And again, I'm reading these for the benefit of the folks on the phone that might not be following the webinar. The answer is generally yes. So if you want to, we've worked with some self-directed platforms before. Again, email any one of the 5 people on the screen, and we can talk about it, how to get that in. And the minimum, we had a few actually questions group. The minimum is 100K accredited investor accreditation to come into the fund. So that is hopefully just from an operations standpoint. Then we had one that was from folks that are asking questions that are associated with a larger broker dealer, such as like an LPL or a Commonwealth or RBC. As you can imagine, there are centralized research functions at a number of those firms. So to not get into any of those specifically, I would say, send us an email and we can direct you to which platforms we're approved on, or where we are in terms of getting approved on some of those larger broker dealer platforms, because those are certainly things that are in the works right now. I want to make sure that I'm getting to everyone's questions. So one, there's been a lot of migration to the Midwest. Why not focus there?
Yeah, I would say I spent a lot of time covering the Midwest in my career, and you don't want to chip your hand too early, and we have not fully developed this mandate yet, but we actually have started looking at properties in Columbus, Ohio, Indianapolis. We have some experience there, done well there. We're just trying to see if that is a long-term sustainable trend or not. So right now, it's a slam dunk that the Sun Belt is where all the corporate relocations are happening, job and population growth is happening. So we're looking, but I'd say not ready to pull the trigger over the next quarter or so. We would need to have more conviction behind what we're seeing there. And we also need to feel that there's a meaningful discount in your cap rate, because the Midwest tends to be less liquid than some of the other primary, secondary Sunbelt markets. And generally speaking, when there's a lot of liquidity in the market, those discounts tend to compress. So that's another gating issue for us, is there enough of a discount to do something in the Midwest today? So to be determined on that one.
And then there are a few, I think they're probably, Eric, this is up your alley, but we had a few questions that talk about, have you had a first close? Have you done a fund in the past? And then how is the management fee calculated? So a bit more of the operational blocking and tackling of those. So I'll group kind of all 3 of those into structure.
Yeah, happy to field them. And I've been trying to type some answers here on the Q&A tab as we go. And I think I answered all of these, but happy to answer them live as well. And so let's take those in order again. Adam, could you read those in order again?
Sure. So one was, do you have experience managing prior funds or previous funds?
So on that, on that front, no, this is Croatan's first fund vehicle. You can certainly read the biographies of the senior leadership team, including my public REIT background and Paul's expensive background managing multifamily investments. Croatan being 17 years old, it evolved in the manner that you would expect most private equity platforms to evolve. Early years of friends and family capital, the institutional LP community, kind of started noting what was going on in the solid return track record and the strong team. And so a number of years of doing single investments, raising the GP capital on Croatan side and marrying it with our institutional LP capital partners capital. And then it allowed us for the opportunity to raise a discretionary fund. So we launched the All Weather Fund. It had its first closing in early 2020, with its final closing slated for June 30th of 2021, so later this month. And we've called approximately 65% of the committed capital so far in that fund. However, that number will decrease as the next capital call will have a number of new LPs that have come in most recently into the fund. So the called amount of percentage of called capital, including new LPs that have come into the fund over the last couple of months, that percentage will naturally be lower. Adam, what were the other two questions?
Yeah, the other one that I think we can do these quickly. So there was just how's capital called, and this is a traditional drawdown structure. So as investments are made, we will call capital as it's needed. This is not a full capital draw day one of your commitment. It's a capital call drawdown structure.
And I think the other question was AUM fees are charged based on asset value and only on called capital.
Yeah, which is, and I would say that's an important point. So Croatan, again, another alignment of incentives that we're trying to do for LPs. This is not a vehicle where it's 2% on your investment amount, and after the investment period, it goes to called capital. 2% is on asset value, which inherently is directly related to called capital. So we hope that that provides an incentive and an alignment for LPs to see that it's based on the amount of capital that's actually being managed. In terms of, I think now there's a few more open-ended ones, and I want to try and take these in the direction they came in. Have you looked into ESG investment opportunities, and are you feeling any pressure to begin focusing on, say, decarbonization opportunities?
Yeah, actually, that has been a big push for us internally, and how we're implementing it here is on the asset level and multifamily. Actually, there's a lot of positive forces to compel those. Freddie and Fannie, the program is off and on at times, but they give discounted financing rates if you do green initiatives, energy saving, water saving initiatives. So that's a no-brainer for us to do. So we are implementing that on site. We're even exploring other initiatives such as perhaps on-site composting, recycling facilities. So it is an easy way for us to participate in the whole ESG initiative, because multifamily rental housing it's easier to lift than maybe an office building. To retrofit that is not as a quick and not as cost effective.
And then there's three questions. I'm going to read all three of these together because I think they all tie into the same general theme. Was how are you planning for project inflation, and how do you believe this will affect your IRRs? What's your outlook on inflation and its effect on rates, costs, valuation? And as cap rates are compressing and interest rates rise, where do you see rent growth and IRRs shaping out? So I think this is all about future expectations for inflation, interest rates, and how that affects our return profile and underwriting and cap rates.
We're watching inflation very closely. I think given all the monetary policies and all the stimulus out there and all the money flowing out there, I think you'd be a fool to ignore it. Now, one benefit, which we probably should have highlighted in our presentation, is multifamily in particular, at least from the rental perspective. We actually think it'd be a beneficiary of inflationary pressures, the ability to push rents. So it's a pro and a con, right? So if you look at the ability to push rents, that's a positive. But then you look at pressures on rates rising, that clearly has an effect on your forecasted returns. So how do we forecast it here internally? So that's why when we listed our projected returns from certain investments. Where are we underweight? We're underweight suburban garden acquisitions because that's where cap rates are the lowest. If you're buying a piece of real estate for whatever cap rates are, 3.5%, 4%, 4.5%, and you had to expand that by 100 basis points, you're starting at such a low basis or low point. That's a tremendous erosion in your trading multiple. So you need to have a lot of rent growth to overcome that. That's why we're underweight that concept right now, because we think the returns by buying are 8 to 14% for conventional acquisitions. And And I think that's more, that's probably fair for this world. I think that factors in some of the dynamics we talked about, but we're overweight the other initiatives that I think could be even a better beneficiary of inflationary pressures. For example, developing at $100 and then monetizing for $140. If there's ever any downward pressure on valuations and trading multiples, you have to lose $40 of value in order for your basis to be affected. Same concept with preferred equity. If you're investing up to the 85th dollar in the capital stack and there's $15 of equity shielding you from losses, if there ever is any downward pressure or values go to different direction, you have some cushion there. Then with the urban core, we just think we're buying for 75 cents on the dollar. And that's just a huge recovery story. Not only will inflation help propel rents there, but the micro recovery story of the downtowns and cities as companies pull workers back to the office and amenities reopen, I think will help buffer some of those pressures. Did I cover everything? Or did I miss anything there?
I think that.
Yeah, so we're elevating our exit caps, just so you know. Our general exit cap for let's say Class A well-located properties, 3 to 5 years out, about 5% or so to 5.25. So that's a pretty, I'd say, conservative outlook, which is why our IRRs are penciled out to be as low as they are. Whereas the market, I think, generally speaking, is forecasting higher IRRs than we are.
Okay, we just got two similar questions. What leverage do you feel comfortable with now? What's the average leverage you employ, the maximum, and what's your current cost of debt? And how do you look at mortgage term and the duration of hold period and exit strategy? So I think there's a bit there about debt and leverage. If we just want to unpack those.
Go back to our portfolio, we've been about 70% leverage. So I'd say going forward, a range of 65 to 75 continues to feel like the right spot. So that's the easy answer. And then the current cost of debt, well, it depends. So when you look at our current portfolio, we refinanced a lot of our assets in 2018, 2019. I think I mentioned earlier, we were getting defensive and batten down the hatches. Didn't want to take on any refinancing risk during a downturn. So our cost of debt today is around 4 to 4.5 on those assets. We also have some debt that's locked in at sub 3%. If you actually took on a new mortgage today, depending on the leverage level, let's say that 65 to 75% range, you're going to be 3 to 3.5% right now. So still pretty cheap. Now, as far as duration, we like to marry the execution to the duration of the loan. So there are some executions that are more transitional, like a development play or heavy repositioning, where that's a 2 to 3 year exit. Well, you want to have a loan term that allows you to get out and monetize the asset within 3 to 5 years. So that more than likely is going to be a 3 to 5 year loan. Now, outside of that, we prefer to go long on our debt and put in 7, 10, 12, 15 year money within our seed assets. 3 of the assets are financed with 12 to 15 year money. The 2 pref deals are 7 to 12 year money. The Atlanta property is a 5-year loan. But I'd say we like to have a combination of both, and it really is driven by the execution plan there.
Thanks, Paul. I think there's two other questions. One was outside of fees, how much equity is the GP putting it, right? So what's the GP commitment?
Yeah, so I can handle that. The principals at Croatan and related parties of the principals have in excess of $7 million invested in the all-weather fund. And so I think that's an alignment of incentives that's greater than just about any other fund on the market. So we're very proud of that.
This one, it might make sense to unpack this and maybe go back to the terms. So we had a few that, what are the liquidity options? So I think it makes sense to talk about liquidity, what this fund does, but what it doesn't do, and the optionality that it builds in. So if we want to just talk to the liquidity of the fund, quote unquote.
Sure, happy to touch on that briefly, and certainly if anybody has any follow-up questions, feel free. We can provide much more detail offline if necessary. So to Adam's point, let's talk about what the liquidity feature is not. So the investors in the fund have liquidity at their sole discretion after a 3-year investment period. And the 3-year investment period starts at fund closing, which is June 30th of 2021, so a month from now. So there's a 3-year lockout period, and after that, liquidity at the investor's sole discretion. What does liquidity mean? Well, what liquidity does not mean is that if an investor opts out, either in whole or in part, that we're going to go fire sale investments to meet liquidity needs. That would be, I think, directly contradictory to the opportunistic investment thesis, and I think the track record that we've demonstrated and wouldn't allow us to execute the business plan that we went into the investment with, monetize that profit, and then be able to redeploy it. And in the process of fire selling, hurt other LPs in the fund. So what it does mean when you opt for liquidity is it means that you immediately get set up with a liquidating account, and any cash on hand and any cash flow from operations, refinances, or the disposition of the sale of assets or disposition of investments, as that cash comes out, rather than being reinvested, rather than either your original capital or your profits continuing to reinvest it, it all goes into a liquidating account and comes to you immediately in cash. So there will be some time period to enjoy that liquidity function, but what it also ensures and protects each LP is if somebody else liquidates, we're not going to prematurely sell an investment. And so we typically guide people to a couple of guideposts to think about liquidity. We obviously have a buy and syndicate execution where we're turning that equity over very quickly in a matter of months. So there already is a large part of your original capital and profits that can be returned very quickly. The average hold period of our investments over the last 17 years is approximately 4 years. And so at any given time, if you raise your hand, just mathematically speaking, kind of the average of the existing investment pool will be about 2 years. So you can think of a curve that starts immediately with returning capital to you and dovetails, over that next kind of 2 years on average period. But again, we will not reinvest any of your original capital nor your profits once you raise your hand and elect that liquidity, that opt-out feature. So hopefully that was helpful, and we're happy to provide any more details offline.
Yeah. And I don't see any new questions. And so hopefully with Eric's answer, some of the thought that's going through folks' heads that's on the call right now, that this feels different in terms of structure and the opportunity set. And what we would say is it's done intentionally. We hope that you found kind of through Paul's vision and the fund that Paul, Eric, and also Jeff have put together, and the structure and the firm that we've built, it's more LP friendly and more LP aligned, and that was done with intent. So I don't think we have any other questions, but as you can probably tell from the three of us, we're happy to talk more at length. We're happy to do this again for anybody that wants to reach out one-on-one, talk to myself, talk to Paul or Eric directly, or anybody else from the team. Again, the presentation we used, all the contact information is in the email that you got from Flya, and I'll just say thank you to our gracious hosts. Thank you to everybody for joining. Thank you to Paul and Eric. And please don't be a stranger. Feel free to reach out if anybody has future questions.
Thank you.
Croatan team, thank you guys. Great job today. Thank you all for attending. That concludes today's session. We'll be following up with you tomorrow.